The United States economy is facing strong headwinds. The imposition of tariffs, taxes on imported goods, is creating significant uncertainty. Businesses are hesitant to invest and expand. Consumers are worried about rising prices. This uncertainty can have a chilling effect on economic growth. The stock market, often seen as a barometer of economic health, has been volatile. This reflects the nervousness of investors about the future. The trade war with China, fueled by tariffs, is a major source of concern. The possibility of a protracted trade conflict is weighing heavily on the global economy. Goldman Sachs, a leading global investment bank, has raised its probability of a U.S. recession. They now believe there is a 35% chance of a recession in the next 12 months. This is a significant jump from their previous forecast of 20%. The bank cites the impact of tariffs as a key factor in their revised outlook. Economists at Goldman Sachs point to the escalating trade tensions. They argue that tariffs are likely to lead to higher prices for consumers. This could dampen consumer spending, a major driver of the U.S. economy. Furthermore, businesses may be forced to cut back on investment and hiring due to increased costs and uncertainty. This slowdown in economic activity could tip the country into a recession. The potential impact of tariffs on consumer spending is a major concern. Tariffs lead to higher prices for imported goods. This means American consumers have less money to spend on other goods and services. This reduction in consumer spending can have a ripple effect throughout the economy. If consumers cut back on spending, businesses will see their sales decline. This could force businesses to lay off workers. Rising unemployment would further reduce consumer spending, creating a vicious cycle. The Federal Reserve may respond to a weakening economy by cutting interest rates. However, the effectiveness of rate cuts in stimulating growth remains uncertain in the current environment. Adding to these economic worries is the growing U.S. national debt. As of 2025, the national debt stands at a staggering $28 trillion. The government faces significant challenges in refinancing this debt, especially with interest rates expected to rise. Servicing the interest payments on this debt will require a significant portion of the federal budget. This limits the government's ability to invest in critical areas such as education, infrastructure, and research. A large and growing national debt also risks crowding out private investment. Investors may be hesitant to lend money to businesses when they can buy U.S. government bonds, which are seen as a safe haven. This crowding out effect can stifle innovation and economic growth.